Well, today we got the government's first estimate of GDP growth for the first quarter of 2017. And if you remember, the Atlanta Fed had been steadily reducing its estimate for first quarter growth since February 1st of this year, when it was estimating 3.4% GDP growth. And the last downward revision happened yesterday as a result of more weak economic data, particularly on inventories, that came out yesterday. The Atlanta Fed made its final revision to the estimate for Q1, at least the estimate that we got today. And they were down to 0.2, the lowest it had been. Now, the consensus for Q1 had also come down, but not nearly as quickly or as much as the Atlanta Fed. But going into this morning, the consensus estimate was for 1.1% GDP growth, which would be a sharp, reduction in the 2.1% GDP growth that the government claims we had in the fourth quarter of last year. And the range of forecast went from a high of 1.7 to a low of 0.7. Nobody was quite as low as the Atlanta Fed. Well, we got the actual number this morning, and it was 0.7. So the Atlanta Fed was a little bit too pessimistic. But, this is just the first estimate. If you look at the economic data that has been coming out this year, the later the data comes, the worse it is. So if that trend continues over the next month, as the government continues to get additional data from which to figure out Q1 GDP, there's a very good chance that they're going to revise this number down. And maybe the Atlanta Fed's 2.2% will end up being correct, or maybe it'll end up being too optimistic. I think there's still a good chance that by the time they get the final revision of this done, and that's not going to happen for another couple of months. I mean, the second quarter will almost be over by the time we get the final estimates for Q1. We could end up with a negative number for Q1 very easily. And personally, I think the second quarter will be even weaker than the first quarter. So if we end up with a negative number for the first quarter, we're probably definitely going to get a negative number in the second quarter, which means by the time we get the negative number, if the second quarter is pretty much over and it was also negative, then we're actually in a recession. We would have completed 2 quarters of negative GDP growth without anybody realizing that it was even coming, let alone that we were already in it. In fact, thus far, the Federal Reserve has not changed its rhetoric at all to try to dampen expectations for additional rate hikes later this year. Even though the Fed is supposedly data dependent and the data that they claim to depend on has collapsed, they're acting as if nothing has changed. The question is, will they continue to act like that over the next several months as more and more bad economic data comes out? I get a lot of crap from people, particularly, in the media, not that I'm on that often, but with respect to the fact that I had made predictions that the Federal Reserve was not going to be able to raise interest rates. And one of the reasons that I believed that they wouldn't raise rates was I thought that they would use the weakening economic data as an excuse not to raise rates, that they can hide behind that. In fact, that's why they always left that caveat out there, that nothing was on a preset course, that it was all dependent on the data, and the data would have to come in line with their estimates, which it has not done. I mean, I was confident that the data would be weak, and I was right. The data has been very weak, yet the Fed has ignored all that weak data, and they've raised interest rates anyway, though they've raised them minimally, right? They've done the littlest that they could basically get away with and still pretend that everything is fine. I mean, that's one of the reasons that they ignored all the weakening data, because they hoped that maybe by ignoring it, it would go away. If they kept pretending that everything was good, and proof that they thought everything was good was the fact that they were raising rates, and maybe they thought psychologically that they could impact the markets. But I still believe that my underlying assessment was correct. They've barely raised rates. And the reason they've barely done it was because the economy, the bubble economy that they inflated, could not withstand normal rate hikes. And the proof is that here we are, Q1 GDP. This is the weakest growth in 3 years for a quarter. And I bet it's going to be weaker than this. Why is GDP growth so weak? Well, one reason is because they've raised rates, even though they've barely raised them. Imagine how deep in recession we'd already be if the Fed had delivered the 3 or 4 rate hikes in 2016 that the markets believed were coming at the end of 2015. We only got 1 rate hike. But despite the fact that we've only got, 3 rate hikes of 25 basis points, we're not even back to 1% yet. But despite that, we're probably already in a recession. And of course, the recession was inevitable because none of the problems that led to the Great Recession and the financial crisis were solved. They were all exacerbated. We simply, delayed the day of reckoning until a future date, which, we are now arriving at that future. By the way, the weakest component of the GDP was consumer spending. I think this is the weakest consumer spending growth. I mean, consumer spending was up, but just by a tiny fraction of a percent. It was the smallest increase in consumer spending in about 7 years. You got to go back to 2009, right, during the last recession, to find a number this weak for consumer spending. Another interesting fact is that if you look at the weakness in GDP for the quarter, there hasn't been a quarter this week in which the Federal Reserve raised interest rates since 1980. You're talking about 37 years. This is the weakest quarter in 37 years in which a data-dependent Fed raised interest rates. You would think, gee, if they're really data-dependent, why would they raise rates in such a weak quarter? Now, you could say, well, they didn't realize the quarter was going to be so weak when they raised them. Okay, then why haven't they communicated to the market that maybe that rate hike was a mistake, that maybe they should take it back, right? Because they thought the economy was going to grow at 3%. Instead, it barely grew, at all. Yet they're not going to admit that they made any kind of mistake. As far as the Fed is concerned, the data is exactly what they expected. I mean, the data is matching their expectations, which is why they raised rates and which is why they are planning on continuing to raise rates. Another disturbing part of the number, at least disturbing if you look at it correctly, is the GDP deflator, the price index. Now, last quarter, prices rose 2.1% on an annualized basis, again, according to the government. And they were supposed to rise by 2% this quarter. Instead, they rose by 2.3%. So 0.3% above expectations and 0.2% above the prior quarter. So growth was much less than forecast, while inflation was significantly higher than forecast. And that trend should be disturbing, and it will continue, meaning that economic growth will stagnate or vanish, and consumer prices will continue to rise. And of course, this is actually a dilemma for the Fed because they're looking for price stability, which they have now redefined as prices going up 2% a year, which to me is hardly stable, but that's their new benchmark. But now we're looking at 2.3% annualized rate and climbing. It's not going to stop here. It's going to keep going up. But growth is going to fall.